The Fed cuts, but hawks push back. Indian autos roll on, and my take on Uber. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. It's nearly time for us to say goodbye to 2025. And given that we are heading into the festive period, I have some major announcement to make, which is that this episode is when I will have to say goodbye to you in 2025. In other words, it's not just welcome to episode 148, it's also welcome to the final episode of 2025. Um, before I start the show, it'd be very unfair if I didn't thank you for all the love and support you've given me, given me, and given to the show over the course of the year. So thank you very much from the bottom of my heart. And I wish you all and your families, a very Merry Christmas. Yes, I said very Merry Christmas and a fantastic 2026 in advance. I hope all of you get to spend quality time with your families over the holiday period. And, I also want to say that we will finish 2025 two episodes shy of the magical number of 150, which means that special episodes are set to come in very early in 2026. Remember, 150th episode, I can guarantee you, will be a special episode. I definitely also have a couple of special plans up my sleeve for the show and for making the show better, rather. Not going to reveal anything right now. More will be revealed next year over the course of more will be revealed over the course of next year. Having said that, it's not goodbye yet. We still have one more show to do. We still have episode 148 I still have episode 148 to deliver to you guys. So let me quickly give you a quick recap of what transpired in the markets before we dive deeper into the key developments of the week. Last week firmly belonged to the Fed. There was only one major player that was influencing the markets. While the AI trade did try to be that one major player, it was all about the Fed. As they had as investors experienced the final Fed meeting of 2025. While like I said, while AI trade also led to some volatility, which took down Nasdaq, the Fed's decision and the comments had a lot more role to play in investors' decision making. All said and done, once the dust settled, although the Dow advanced 1.1% for the week, both the S&P 500 and the tech-heavy Nasdaq slipped, with the S&P 500 going down 0.6% and the tech-heavy Nasdaq on account of negative commentary coming out of Oracle's and Broadcom's earnings reports, adding further fuel to the notion that the AI trade is crumbling, all of which led to the Nasdaq to tumble 1.6% for the week. So, for the final time in 2025, let me welcome you to the first segment, Doctor's Weekly Snapshot, and talk about these developments. As I mentioned earlier, all eyes were on the Fed, and the central bank didn't disappoint as it concluded its final Monetary Policy Committee meeting of the year by delivering a third straight 25 basis point cut in interest rates. Now, let me be very clear, the 25 basis point rate cut was not surprising at all, given the odds of a rate cut reached upwards of 80% just prior to the meeting. As such, investors and economists were more keen on the Fed commentary regarding the future, especially since the final meeting of the year took place amidst so much data uncertainty, courtesy of government shutdown, which is not exactly a great scenario for a highly data-dependent Fed. I mean, if you've followed the Fed like I've done, one thing is very clear: they always pride themselves on being very data dependent. What happens when you have so much uncertain data, though? That's the question, right? So that becomes a challenge. So it was a little bit, there was a lot of uncertainty going on into the final meeting, but nonetheless, despite the uncertainty, Fed delivered exactly what it set out to deliver, which is yet another 25 basis point rate cut. The problem for the Fed and for investors is the future looks as uncertain as it can be, and probably if it was uncertain for the December meeting, certainly more uncertain now. The Fed signaled that it may be done for now when it comes to rate cuts, indicating that future cuts would likely require clear evidence of labor market deterioration rather than just preemptive adjustments. While this could certainly be construed as an indication of a pause going forward, one aspect that suggested that the Fed has left the door opened, no matter how marginally, for a future rate cut early next year was the enhanced focus that Fed Chair Jerome Powell and company placed on the labor market. For instance, Fed Chair Jerome Powell justified the 25 basis rate cut in December by noting that the labor market has cooled a touch more gradually than anticipated, with job growth potentially being negative since April after adjusting for overcounting. In addition, the post-meeting statement removed language describing the unemployment as having remained low, acknowledging that unemployment had indeed ticked up to 4.4% in September. Moreover, Fed Chair Powell, in a very unusual move, also cast doubt on jobs data, which is, it's extremely, believe it or not, it's extremely unusual for me. I've never seen him place emphasis on one aspect when it is supposed to fight the dual mandate of jobs and inflation. More specifically, Fed Chair Powell indicated that official federal data may be overstating job creation by up to 60,000 positions per month, raising the possibility that the US economy is currently shrinking rather than growing. This would mean that while official figures show the economy adding approximately 40,000 jobs monthly since April, the reality could actually be a net loss of 20,000 jobs per month. That is a dramatic swing, ladies and gentlemen. The actual data says 60,000 positions per month. Economy adding approximately 40,000 jobs per month in April. Reality could actually be the economy losing 20,000 jobs per month. The Fed attributes this significant, and I'm very, significant, maybe an understatement actually, significant discrepancy to the birth-death model, a statistical tool that the Labor Department uses to estimate hiring from new business formations, which cannot be surveyed directly. The problem with this model is that it has historically overstated job creation by hundreds of thousands of jobs on an annual basis, leading to large downward revisions later. While the Bureau of Labor Statistics, BLS, which is the Labor Department, has announced plans to adjust the birth date model starting in February to improve accuracy, the fact that Fed officials don't really believe that the current optimistic labor market numbers was the primary driver behind the decision to cut rates by 25 basis points. Now, the reason I say this is a very unusual move from Fed Chair Powell when he sort of emphasized more on the labor market rather than on the inflation front is because Fed officials, including Chair Powell, have always stressed that they're focused on the dual mandate of jobs and inflation. The latest commentary, however, suggests that the labor market may actually be starting to get increased weightage compared to the inflation metric. Now, this is not to say in any way, shape, or form that inflation is being overlooked or is completely forgotten. In fact, the Fed meeting was one that saw the most dissents since September 2019. It saw 3 dissents. One official wanted a higher rate cut. No surprises that official is Governor Stephen Mirren, who is a hire of the Trump administration, whereas 2 officials actually preferred no change. The fact that there were officials who didn't want any rate cut shows that inflation picture is not in the rearview mirror, and it remains significant. It's just that the jobs picture got that little extra weightage during the December meeting. Remember, I did tell you at the start, they're playing with a lot of uncertain data here. Going forward, I would expect more dissents as there appears to be a very clear split among those officials who are prioritizing inflation and those who are prioritizing the job market. For instance, 7 of the 19 participants believe no rate cuts will be warranted next year. 4 others see no more than 1. This brings me to the other key aspect from the perspective of the Fed, which is the whole story of Chair Powell's succession planning. Keep in mind, just to give you some context and just to give you some reminder, Chair Powell is set to retire, is set to step down from his retirement, maybe not, but set to step down as Fed chair in May of next year. And as things stand, either Kevin Hassett or Kevin Warsh, the 2 Kevins as they're popularly known, is likely to become the next Fed chair. Speaking exclusively to the Wall Street Journal, President Trump revealed he's leaning towards appointing either of the Kevins as the next chair. More importantly, though, the president emphasized that his choice must be willing to consult with him on interest rate decisions, breaking from the recent norms of central bank independence. Now, while this might have been shocking declaration from the president and all that, and while the prospects of central banks' independence getting killed under the current administration has been a long-standing debate, although the question I have to leave you guys with is the central bank ever fully independent? The comments I mentioned earlier from President Trump was the clearest indication that the White House expects to play some role in the Fed's decision-making process. Here's the problem, though. While the Fed chair has significant influence, at the end of the day, he or she has only 1 vote. Just 1. Doesn't have 1819. And the increasing dissent among the voting members show that at the end of the day, what President Trump wants and whoever he selects for the Fed chair is going to have their work cut out if they follow President Trump's instructions to bring down interest rates. In other words, despite political noise, economic data is likely to remain the primary driver and is likely to remain. Economic data was the primary driver up until now and is likely to remain the primary driver going forward. I did tell you that 2025 has been all about volatility. Remember the entire show, and throughout the year, it's volatility is the name of the game. Volatility is the name of the game. Volatility is the name of the game. Multiple times I've mentioned it when it comes to the markets. Based on evidence from the recent Fed meeting, though, ladies and gentlemen, it looks like the volatility has spread to the Fed too. On that note, let me welcome you. Let's go straight from the US to India and welcome you to the next segment, Doctor Goes Home, one last time in 2025. Now, a bit of a delay on this one, on the theme that I want to discuss in the current segment, given that there was no episode last week, unfortunately. But as always, you guys know that a new month means it's time to take a pause on all the market action and focus on the Indian auto sales numbers, right? A bit of a delay, should have been last week. Now it's been pushed to this week. Long story short, whether it's pushed last week, whether it was last week, this week. Long story short, India's automotive sector experienced robust growth in November, driven primarily by significant tax reductions enacted in late September that lowered vehicle prices, stimulated consumer demand. Major manufacturers reported double-digit sales increases, with market leaders struggling to ramp up production fast enough to meet the sustained post-festive season demand. When is the last time we've talked about a supply problem and not a demand problem? Let's get to the top car makers individually now to really seal this deal about how much demand there is and why companies are suffering from a production standpoint. India's largest car maker, Maruti Suzuki, achieved its highest ever monthly sales in November, recording a whopping 26% year-over-year increase with 229,021 total units dispatched compared to 181,531 units in the same month last year. This record-breaking performance was driven by surging domestic demand across all vehicle segments and unprecedented export volumes. Domestic passenger vehicles grew by 21% to 170,971 units, reflecting broad-based demand resilience beyond the typical festive season. All segments, unlike the previous month, saw positive growth, although UVs were the primary driver. The company, India's largest car maker, also posted its highest ever monthly exports, which surged 61% year over year. Very, very strong month for Maruti. Hyundai also had a strong month, registering total sales of about 66,850 units, driven by strong 27% year-over-year growth in exports. The robust export growth specifically underscores the company's long-term strategy to establish India as a central node in its global manufacturing and supply chain network. My new favorite automaker, Mahindra & Mahindra, also had a phenomenal month, saw its PV unit register a strong 22% year-over-year sales growth, driven by GST 2.0, strong rural sentiment, and continued government support. Finally, moving on to Tata Motors, TAMO also recorded a robust performance in November, registering a 26% year-over-year in total sales to 59,199 units. The growth trajectory was mirrored in the commercial vehicle segment, which also saw double-digit gains in both total and domestic dispatches. Sales in India grew by 22% year-over-year, reaching 57,436 units compared to 47,063 units in the same period last year. That's the four-wheelers. Now we move to two-wheelers. Hero MotoCorp reported a significant surge in performance for November, registering a 31% year-over-year increase in total sales. The two-wheeler giant successfully breached the 6 lakh unit mark, signaling a robust recovery and strong market demand. TVS Motor continued its stellar growth, registering a 30% year-over-year growth overall. Exports continued to surge for the company, registering a whopping 58% year-over-year increase for November. Royal Enfield continued its upward trajectory, registering a 22% year-over-year growth. Exports reversed their decline for Royal Enfield from October, and they moved into the growth trajectory, although the growth was a modest 2%. Bajaj Auto also had a positive month, although the growth was significantly more modest in November compared to October. Long story short, bottom line, November simply maintained October's momentum as the GST 2.0 reforms continue to drive the growth for Indian automakers. No bigger example of this than Maruti, which like I said before, saw its highest ever November sales in 40 years. The other positive development was the growth was broad-based with strong customer demand across both urban and rural markets. As for auto investors, more positive news could be on the horizon as 2025 looks to end on a high, with dealers projecting sustained demand momentum even in December. The Federation of Automobile Dealers Associations, of FADA, reports that the dealer confidence remains high due to robust inquiry pipelines, ongoing wedding season, and attractive year-end consumer schemes. Approximately 64% of the dealers anticipate sales growth in December, and with few 2026 model launches, including in the EV space, and increased rural liquidity, the growth story is expected to remain intact for Indian autos for the foreseeable future. From a valuation perspective, things do look a little dicey, with the current price to earnings of Nifty Auto Index of approximately 30 times remaining historically high, indicating little margin of safety for new investors entering at these levels. As such, I'm going to end the segment by saying that caution is certainly warranted before going gung-ho about the auto stocks, despite their monster growth trajectory. On that note, we're nearing the end of the final show of 2025. Let's head to the final segment, Dr. Dissects, where this week we're moving away from the Mag 7 constituents and we're shifting gears into ride-hailing. No pun intended there, as we wrap up 2025 with one of my favorite names in the market, Uber Technologies, ticker symbol Uber. The company delivered yet another strong quarter last month, beating both the top and bottom line estimates once again. More specifically, Q3 revenues came in at $13.5 billion, up 20.5% year over year, and beating analyst estimates by $240 million. Diluted EPS came in at about $3.11, up a whopping 159% year over year, and blowing past analyst estimates of 69 cents. Investors must factor in that the significant EPS beat was primarily due to an additional $4.9 billion benefit that Uber gained from a tax valuation release and a $1.5 billion pre-tax gain on account of revaluation of Uber's equity investments. So take that 159% year-over-year growth in EPS with a little pinch of salt. Nonetheless, overall numbers were great. Q3 gross bookings grew 21% year over year, coming in at $49.74 billion, matching the upper end of the company's guidance. Adjusted EBITDA of $2.26 billion was also near the upper range of the company's guidance, but its growth of 33% year over year was the lowest growth in the last 5 quarters. The company generated operating cash flows of $2.3 billion, ending the quarter with $9.1 billion in unrestricted cash equivalents, and short-term investments. For Q4, the company expects gross bookings to come in between 52.25 and 53.75 billion, which assumes an approximate 1% currency tailwind. Adjusted EBITDA is now expected to be in the range between 2.41 and 2.51 billion, which would represent a year-over-year growth in the range between 31 and 36%. One of the key takeaways for me from Uber's Q3 report was how autonomous vehicles are slowly but steadily contributing to the company's bookings, subsequently to the company's top line. This was seen in the growth in the number of trips, which actually jumped to 22% after being at 18% for 3 consecutive quarters. This is the strongest growth since the end of 2023, indicating that all the partnerships that Uber has made with various AV companies are starting to pay off. The partnership with Waymo is the biggest AV contributor for Uber, as evidenced by Austin and Atlanta, where Uber has partnered with Waymo, growing at a much faster rate than other US markets. Now, while the autonomous vehicle market is still in its infancy, Uber is establishing a very strong foundation that will allow it to capitalize when the market eventually delivers exponential growth. The clearest evidence of this is Uber's recently announced partnership with NVIDIA. Under the terms of the partnership, Uber plans to oversee end-to-end AV fleet operations, and the AVs will be developed on NVIDIA's Drive AGX Hyperion platform. Stellantis, a European car maker, Stellantis will be the first automaker that will deliver at least 5,000 of these L4 autonomy vehicles for Uber's robotaxi operations, both in the US as well as internationally. Now, personally, I don't see Uber managing its own AV fleet for the long term. I continue to believe that Uber would be the platform where other AVs would join through partnerships similar to the ones the likes of Waymo and VRide have made. The partnership with NVIDIA, to me, has more to do with rideshare data, which is vital if the AV revolution has to take off and become successful. Given that Uber is one of the biggest global presences relative to its peers, the amount of data that Uber will have through the NVIDIA partnership will be a goldmine for any AV player. The ability to collect this vast amounts of data and then share it with AV players, which Uber management mentioned during the Q3 earnings call, in my view, is the biggest catalyst that would enable Uber to boost the number of AV partners in the months and years ahead. The partnership with NVIDIA may be at its early stages and is unlikely to contribute to the company's bottom line in the near-term future. However, to me, this partnership is what would enable Uber to remain one step ahead of its rivals when it comes to the battle for AV dominance. It is not surprising, therefore, that CEO Dara Khosrowshahi included autonomous vehicles as one of his 6 areas of strategic focus. One of the reasons why Uber's stock may have declined post its earnings release and has been free fall since then is the statement made by Mr. Khosrowshahi, whereby he said that AVs are unlikely to be profitable for a few years going forward. Now, this cannot come as a surprise to investors, so I don't really understand the post-earnings sell-off. And so for me, it's not a valid reason to sell the stock. It's very early days of the AV revolution, and as such, the focus of every player as well as every rideshare company would be growth. I would have understood the market reaction if Uber was an unprofitable company and at the same time was bleeding money. Neither of these are true. At the end of Q3, Uber's total cash and cash equivalents stood at $9.1 billion, which is about $1.7 billion more than Q2's total. Moreover, Uber's 12-month trailing cash flow stands at $8.7 billion. With respect to EPS, even when one excludes the tax revaluation, Uber remains profitable. Finally, adjusted EBITDA margin as a percentage of gross bookings came in at 4.5% for Q3, an all-time high for the company. Taking all these together, I believe that the market's reaction to the statement regarding AV's unprofitability is clearly overdone. If there is one area that I do find concerning, it is that Uber has not further expanded its partnership with Waymo since they last announced a partnership expansion in September of last year. I was hoping that Uber would be Waymo's partner when it eventually launches in London next year, but as things stand, that has not been the case. Despite partnering with multiple AV companies, Uber's management disclosed during the earnings call, as I mentioned earlier, that Waymo remains the biggest AV contributor for Uber. Therefore, a lack of further partnership expansion with Waymo is concerning, especially since Uber's direct rival in the US, Lyft, has also announced a very similar partnership with Waymo. Overall, though, while investors need to monitor the Waymo partnership carefully as well as Waymo's growth carefully, all things considered, Uber is certainly heading in the right direction when it comes to positioning itself for the AV revolution. The partnership with NVIDIA is a game changer, in my opinion, and the data that would be collected as part of this partnership would be, in my opinion, the very next catalyst for the ride-sharing growth. It is not. So that was the AV takeaway from Q3 earnings. It is not surprising to me. The next takeaway was it's not surprising to me that Uber management has decided to establish the delivery segment, which includes Uber Eats, as one of its 6 areas of strategic focus. The segment has exceeded all expectations in the post-COVID era, and Q3 was no different. The segment's gross bookings in Q3 was the highest in 3 years, and the segment's Q3 revenues saw their highest growth since Q2 of FY22. Even as the mobility segment bounced back, the delivery segment has sustained its momentum with the 47% growth in adjusted EBITDA, providing further evidence of this momentum. The company continues to expand its merchant base, and the company's expansion into grocery and retail drove the growth in both first-time users as well as monthly platform frequency. The last time I talked to you guys about Uber, I talked about how investors shouldn't underestimate the growth seen in the delivery segment. With Uber prioritizing AVs with renewed focus, the segment should have stronger tailwinds in the coming quarters. Let's talk valuation now. We always do, and I've already written, I've already made some notes already, pen and paper ready. The last time I dissected Uber, I had expected Uber's Q3 bookings, gross bookings to come in at 49 billion, which is the midpoint of the guidance at the time. Now, the actual gross bookings of 49.74 billion came in closer to the higher end of the company's own guidance. Q4 has seasonally been Uber's strongest quarter, and as such, I've assumed Uber's Q4 gross bookings to be at the higher end of the company's guidance, which is 53.75 billion, higher than my previous estimate of 52.9 billion. Total gross bookings for FY25 would then be projected to come in at $193.1 billion, higher than my previous estimate of $191.5 billion. Now, the company's Q3 adjusted EBITDA came in at $2.26 billion, which was closer to the high end of the company's guidance. The adjusted EBITDA represents 4.55% of the company's gross bookings. Assuming the adjusted EBITDA represents the same proportion of gross bookings for Q4 adjusted EBITDA would come in at $2.45 billion, which would then mean that the total adjusted EBITDA for FY25 would be projected to come in at $8.8 billion, which is the exact same figure as last time and represents a year-over-year growth of 37.5%, well within the company's growth projections of high 30s to 40%. Now, to determine the adjusted EBITDA at the end of FY26, I carried out something called Monte Carlo simulations along with a scenario analysis. First thing you need to know, I did a Monte Carlo simulation plus scenario. Monte Carlo simulation plus scenario. All right. Now, more specifically, 10,000 simulations were undertaken with the following randomized variables. You have the, can you see? Okay, there we go. You have the gross bookings growth with a plus or minus 25% standard deviation, adjusted EBITDA margin expansion, plus or minus 15% standard deviation, competitive intensity impact, minus 10 to 5%. That's here. Then you have drag on margins due to these AV investments, minus 0.5% to 1.5, minus 0.5% to minus 1.5%. Then you have acceleration in ad revenue, plus 20 to plus 50%. And then finally, you have macro or regulatory shocks, which is minus 20% to plus 10%. So these are the randomized variables. Now, for scenario analysis, I assumed a conservative base and aggressive scenarios with assigned probabilities of 20% for conservative, 60% for base, 20% for aggressive. It's very straightforward. Conservative is more macro headwinds and regulatory pressure. Base case is management guidance, consistent execution, and aggressive is accelerated AV adoption and advertising and significant advertising upside. So these are how the scenarios are defined. The adjusted EBITDA for FY26 after the Monte Carlo combined when you combine Monte Carlo simulation plus these various scenarios comes out to be 11.79 billion. Okay, the adjusted EBITDA, projected FY26 adjusted EBITDA comes out to be 11.79 billion, which would be a 34% year-over-year growth. Now, according to Seeking Alpha, Uber currently trades at a forward EV to EBITDA of 21.9 times, around the same levels as its long-term median of 21.5. At this multiple, the company's enterprise value becomes $258.32 billion. Now, I also undertook a separate Monte Carlo simulation to determine Uber's ending cash and debt levels under each of the scenario, conservative, base, and aggressive. And then I took the weighted average. So weighted average, when you take all of that, comes out to be it comes out to be total net cash. It's not going to be net cash. It's going to be net debt of $1.2 billion. This would imply then you say enterprise value of 258, 1.2 billion debt. You then get an equity value for Uber at 256.3 million. 256.3 million. 256.3 billion. Billion with a B. Finally, one more Monte Carlo for you guys. I deployed a Monte Carlo analysis yet again to determine the total number of shares outstanding at the end of 2026 after accounting for potential stock buyback, stock-based compensation, and option exercises. The analysis gave the total number of shares outstanding at the end of 2026 is 2.02 billion. With 256.3 divided by 2.02, you get a price target of 127. Price target for my updated price target for it's 127, and it's implying an upside of nearly 50% from current levels. Now, despite the significant upside, investors should be cautious. Why? Because stock has found very strong resistance around the $100 level, and its short-term momentum is completely broken down, as evidenced by the D plus rating on Seeking Alpha's momentum scale. Therefore, despite the significant upside, and while I am upgrading my rating from a hold to a buy, hold was the rating, and now it's buy with a price target of 127. I'm adding a caveat that a dollar cost averaging is recommended when it comes to Uber at current levels. Moreover, any significant pullback is certainly a buying opportunity in my view, and you're already going through that pullback phase. Yesterday, Tesla announced their robotaxi plans. Uber tanked 4%. It's Tesla goes up on robotaxi, Uber goes down, has been a classic trade that's been unwinding, that's been unraveling that's been happening in front of us for a while now. So any pullback is definitely a buying opportunity. The only reason I don't add is like it's significant. It's a very, very core position of my portfolio with a significant concentrated, it's significantly concentrated my portfolio. Now, when I give a buy case to a stock, I certainly talk about the risk factors. The primary risk to my bull case for Uber is the one that I already mentioned before, which is the lack of additional partnerships with Waymo in other cities. As I mentioned earlier, Uber management highlighted the partnership with Waymo has been the biggest contributor to its AV-based trips. As such, a lack of partnership expansion is concerning and is an area the bulls will have to monitor going forward. The other risk is that if the investments in autonomous vehicles made by Uber turns out to be more aggressive than expected due to the evolving AV environment, which is likely to pressure future margins. Excuse me. Any loss of momentum in the delivery business should also be carefully monitored by investors, especially since Uber's management announced that the segment would be one of the company's key areas of strategic focus. Bottom line, Uber delivered yet another strong quarter with a comfortable beat on both the top and bottom line estimates. Mobility bounced back, delivery segment maintained its strong momentum. Management also demonstrated a renewed focus on AVs as they announced a hybrid future, which is human drivers plus AVs, as one of their 6 areas of strategic focus. The company's autonomous vehicle partnerships, especially with Waymo, are already paying off, and its newly announced partnership with NVIDIA would be a game changer in my opinion. The data you collect as part of the partnership is only going to make it a very strong attraction for more AV partnerships across the world. Investors, in my opinion, should not focus too much on the profitability of the AVs for now. It is not prudent to assume that AVs which are still in their infancy would be profitable in the blink of an eye. Uber has the resources to invest, and while they scale up their AV ambitions, their core business are not only firing on all cylinders, but also have the necessary momentum and growth to support the AV initiative. The stock is certainly going through some short-term consolidation, especially around the $100 level. Having said that, I do find current levels to be an attractive entry point, given the significant upside from current levels based on my Monte Carlo analysis. However, while I am upgrading my rating on Uber from a hold to a buy, I would be recommending a dollar cost averaging strategy at current levels, given the subdued momentum or completely broken down momentum, you could say, and the strong resistance around the $100 level. Uber's AV ambitions, ladies and gentlemen, are heading in the right direction. The partnership with NVIDIA should only turbocharge them. That's all the time I have for you this week and for 2025. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, at UTHMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. Once again, wishing you and your families a Merry Christmas and a fantastic New Year in advance, filled with lots of good health, wealth, and happiness. See you in January 2026, ladies and gentlemen. Until then, stay safe and make some money.